From New York City for our viewers worldwide, I'm Bonnie Quinn. Bloomberg Real Yield starts right now. Coming up, Fed Chair Powell opens the door to a rate cut in September, sending stocks surging, also bonds. They're on their best day since May in terms of stocks. The two-year yield falling dramatically on that dovish tone from Jackson Hole. And we're going to go live to Jackson Hole in just a moment for a live report. So we begin with the big issue. Fed Chair Jerome Powell signaling a shift in policy.
The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Joining us now live from Jackson Hole is Bloomberg Surveillance's Lisa Abramowicz. And Lisa, an absolute monster market reaction, not just to equities and Bitcoin and all those traditional risk assets, but bonds rallying strong. We had the two-year yield down almost 12 basis points at one point. Is this what Fed Chair Jerome Powell was intending?
It's clear that he wasn't as focused on the market as maybe going forward, understanding which aspect of the dual mandate to focus on. Originally, there was this feeling that he might be hawkish because a number of central bankers had come out and said they want to focus on inflation. And once again, Beth Hammack of the Cleveland Fed came out after Chair Powell spoke and said, look, this is something I'm more worried about, the fact that inflation has not managed to get down below 2% since 2021 and has actually crept higher since the last time Fed members came to Jackson Hole, to the Grand Tetons. But what Powell said was actually there is going to be a one-time price shock from tariffs. That is what history tends to bear out. And there are signs of cracks in the labor market, while not shocking, are concerning enough to maybe make them err on that side of their mandate, that it may be time to adjust policy. What this meant to markets was opening the door to rate cuts next month. And now the focus is going to be, is it a hawkish or is it a dovish rate cut next month? Is it something that opens the door to many additional rate cuts, or is it going to be a one and done? What we keep seeing is this international presence of central bankers from around the world supporting Fed Chair Jay Powell in his last speech. And this is a real question, how much it will be received in the White House at a time where there has been quite a lot of noise coming from the U.S. administration.
Yeah, fascinating how Powell characterized the labor market situation as a curious kind of balance. We'll be talking about that throughout the day. But you mentioned the White House, and while Fed Chair Powell was speaking, President Trump was also speaking, and he was asked about Fed Governor Cook and why she should step down.
President Trump, you're going to fire Lisa Cook, the Fed governor, over her mortgage fraud?
I'll fire her if she doesn't resign. Yeah, what she did was bad, so I'll fire her if she doesn't resign.
What's being said about this at Jackson Hole, Lisa? It's a very sensitive situation, and I understand the governor is actually in attendance now.
Yeah, and not only that, but there was an individual, James Fishback of Azora Capital, who also was in attendance. And when Lisa Cook, Fed governor, walked into the Jackson Lake Lodge, he started to yell, why did you commit mortgage fraud? And then he was escorted out. It raises this question of tension around all the Fed members, but everybody has pretty much been steadfast in supporting her and saying you need to have any kind of accusation get borne out with a judicial system, and before making any judgments, you need to just let that process carry on. There is a feeling, though, behind closed doors that every single one of the people here is being scrutinized, because it is clear that the president would like to have more control over the board of governors so that he could get policy adjusted more quickly. Although I will say that Michael McKee, who is just here with us on set, made a really good point, which is we have not heard President Trump comment directly on what we heard from Fed Chair Jay Powell just moments ago, which maybe signals that this is okay, because ultimately it does signal in a more accommodative stance, which is exactly what President Trump has been arguing for.
Exactly. He's been calling him slow, but does this count as slow if it happens in September? Lisa, thank you so much. Bloomberg's Lisa Abramowicz there out in Jackson Hole, Wyoming for the Kansas City Fed Symposium. Well, just before Fed Chair Powell spoke, we caught up with Boston Fed President Susan Collins. Now, she said that the Fed's September meeting is not a done deal.
It's about balancing that commitment to restoring price stability with an understanding that preserving healthy labor markets also really matters for the public. And so doing that balance, I would say it's not a done deal in terms of what we do at the next meeting, but a range of possibilities is on the table, and we're going to get more data between now and then.
All right, joining us now to talk about all of this, Tony Rodriguez, head of fixed income strategy at Nuveen, and Meghan Swiber, director of US rate strategy at Bank of America. So, Tony, let me start with you. Is it a done deal? The market certainly went from about 65% pricing in to just under 90%. Not a full rate cut priced in for September yet, meaning people do still think there might be problems in the inflation or employment data coming up.
Yeah, so we think that it is a done deal. We think they will cut in September. We think that the reason Powell sounded maybe a little bit more dovish than maybe the market was expecting is really around three things. Number one is that they believe they're starting from a restrictive stance. So cutting is not necessarily being stimulative, it's just getting a bit less restrictive. So it's recalibrating. Number two, the market offered him the opportunity because it began to price out a full cut. If you go back about 2 weeks, we were over one cut. So again, he didn't have to counter the market. The market was down at 70% probability. And number three is the fact that they're under a white-hot political spotlight right now. So had he sounded dovish, it really just opened up, I think, the opportunity for tweets all weekend around the Fed. And this maybe helped to kind of lower the temperature just a bit in terms of that spotlight.
Meghan, does this lower the temperature? A 12 basis point drop in the two-year yield. Will we retrace some of that?
Well, Bonnie, this was definitely more dovish than we were expecting at Bank of America. Our call has been that the Fed would not be cutting rates this year. That's largely out of consensus. And a big part of that has been the strength of the inflation data. And if you look at the recent inflation numbers that we saw just a couple weeks ago, this is more consistent with a Fed that has historically been hiking than cutting. Definitely more dovish than what we were expecting, but generally endorses our view that you want to be long duration here, particularly at the 5-year part of the curve.
Look, he's clearly very concerned about the labour market. He called it a curious kind of balance where you're seeing supply and demand soft. And I guess, is he waiting to see which one is going to be more important going forward? And will we see that in the next round of jobs data, Tony?
So we definitely think they're going to still be data dependent. We think what he's saying is that we're going to maybe try to look through the inflationary risk, because we agree inflation is higher than what they'd like, but they're already talking about it being maybe a one-time level adjustment versus necessarily feeding into longer-term expectations. So we think the data will be determinant around the labor market. If we see the unemployment rate rise more quickly, they will then cut more aggressively. Our expectation is to see a modest rise. We'll get 2 cuts this year, all part of this recalibration, but we avoid recession, so we don't need a significant string of cuts from the Fed as we move through 2026.
I mean, Meghan, he also did outline several other possibilities, maybe not his base case, but you could have wage dynamics weakening, for example. You could have inflation expectations moving up again. They're by no means completely anchored. I mean, they are for the moment, but there have been times when the Fed has been very worried about that. I mean, what probability do you give to the other outcomes being the case?
Well, one very important, I think, point to make here in terms of the market's response today is that while nominal rates are declining and compressing, inflation compensation is actually on the rise. We like being long break-evens in the U.S. We like being long inflation in the U.S. versus the euro area, because if we do have a Fed that's cutting in this environment where inflation is still a far cry from the Fed's target, we think that the market should be showing more signs of this inflation target moving higher and becoming unanchored from the conviction that the market has historically had in the Fed being able to achieve 2% in the long run.
Tony, do we continue to see this bull steepener then through the rest of the year? I mean, it's right back on in full force today.
Well, we think that the market's already pricing in all of those cuts that we're talking about. So our expectation is it will
end. You think that it is now in the last half hour? We think it is now. Or was it pricing it in before?
Yeah, no, we think now this move has kind of priced in the 2 cuts. So we think the curve will continue to steepen into next year. But in terms of for this year, at a 375 or lower 2-year note, we think that's fully priced in the kind of 1 to 2 cuts we're expecting for this year. So the move to us on the steepener will continue next year. But for this year, we don't see much more of a steepener move left.
What about the idea that we heard from Susan Collins a little earlier? She's a little more on the fence, perhaps, about September than the Fed chair was signalling. Are we going to see more of that pushback? And could that end up changing the committee's mind, Meghan?
I think it's a really tough call. When we listen to Powell's reaction function here, as I mentioned, it's more dovish than what we were expecting. Definitely more of weight put on the labor market versus this inflation debate. We had conviction that we thought Powell was going to be overweighting some of this risk around inflation. But now if we're thinking about a shift to a different Fed chair next year that will likely have more of this dovish reaction function, it really supports this argument to want to be long rates, particularly at the front end and belly of the curve. But getting back to this point on curve steepening, we think that's a very important component of high conviction views, because while front end belly rates may be falling on a dovish Fed right now, these more persistent inflation risks could support a cheapening of the back end of the curve and drive a twist steepening of the US rates curve.
All right, Tony, you were looking for a lot more volatility for the rest of the year. You were also saying that we might see defaults rising now. Is that still your case post-conference?
Yes, I mean, we're comfortable with corporate credit. We just think we've been at abnormally low levels, so we still are comfortable around cash flows, debt levels, et cetera, but we expect to see a modest rise in those default rates. So we could see a modest widening in risk spreads and risk premiums in the credit markets, but we don't think it'll be dramatic because we think we avoid recession and we think companies are still at relatively healthy levels with very open capital markets, so ability to refinance debt, extend debt. So a little bit of an increase in defaults, but not a turn in the credit cycle.
I want to get both your targets for the 10 years, say, by year end. You can give a range. Meghan?
We're at 425 for the 10-year by year end.
All right, Tony?
We're at exactly the same place for year end.
Exactly the same spot. And the risk that we see that not be the case, is there anything in the economy that's that fragile that it could break in that scenario?
Well, in our minds, it would be around the employment data. If we see that continued, say, 35,000 type of job level, and the labor supply does not remain low, then we could see that unemployment rate tick up a little bit faster. We're expecting 4.5% by the end of the year. If we get there sooner and more quickly, then you could see some more cuts, and then you would see the 10-year in our minds at a lower level.
Meghan?
And I'd say the upside risk to 425 would be an environment where the demand backdrop falls out, where we have risks around Fed credibility and independence really challenging the foreign demand investor base and causing the back end to dislocate and see 10-year higher.
Tony, the Fed chair did also talk about GDP growth slowing to around 1.2%. I mean, it may be being characterized as a healthy economy, but there's a lot of fragility out there, isn't there? I mean, we're even seeing it in some of the corporate earnings. And as the Fed chair himself said, there's still a lot of volatility about where tariff rates will end up.
Exactly, and that uncertainty has certainly put a pause on a lot of, say, business investment. For example, we're certainly getting the AI-related data center investment, but other investment has been slowed, and clearly these higher tariffs really impact the lower-end consumers the most. So there's a softening in demand, but where we had thought there might be a downside to below 1% growth in the second half, we're now expecting 1 to 1.5 with a recovery next year to closer to a 2% growth pace. So again, avoiding recession, there's some softness, but allows the Fed to recalibrate their current policy stance.
I forgot to ask both of you, balance sheet runoff, apparently it should stop immediately, should it?
So it certainly could, Vani. We see reasons why the Fed would want to be ending balance sheet sooner, in part because of some of this upward pressure that we're seeing on funding already. We think Fed should be done by the end of the year.
All right, gotta leave it there. Thanks to both of you. Fantastic panel. Tony Rodriguez of Nuveen and Meghan Swiber, Senior U.S. Rates Strategist at Bank of America. Up next, the auction block. August's volume for high grade is heading to $100 billion, even with a little stoppage for Jackson Hole. We talk credit next. This is Real Yield on Bloomberg. I'm Bonnie Quinn. This is Bloomberg Real Yield. Time now for the auction block, where we took a look at sovereign and corporate issuance for the week. We start with Treasuries, where the standout was the 30-year TIPS auction. $8 billion was sold, with the strongest demand since 2017 and the highest yield since 2001. Over in U.S. high grade, it's on pause today with Powell at Jackson Hole, but the sector did manage to top forecast for the week with more than $25 billion in sales. Notable names included Eli Lilly, Charter and McDonald's. And in high yield, broad momentum for the month slowed as the traditional summer slump takes hold. This follows a robust pace of bond sales. At more than $25 billion, August is still the busiest level for the month since 2021. Speaking of credit, legendary investor Howard Marks of Oaktree Capital Management calls it a defensive option.
This is a time to put a little more defense into your portfolio, and investing in credit as opposed to equities is one way to do it. You can say that the promised contractual return isn't as high as it has been historically, or the increment that it provides over treasuries to compensate for the credit risk isn't as high as it has been historically. But you can't say that they don't promise 7.5%. It has a high probability of doing fine, whereas stocks, if the valuations are elevated, have some reasonable probability of doing less than fine.
Joining us now is Meghan Robson, head of U.S. credit strategy at BNP Paribas, and David Rosenberg, head of liquid performing credit at Oaktree. So let me start with you, Meghan, for a reaction to what Howard Marks had to say there. And of course, Fed Chair Jay Powell, what surprised you most about the speech this morning?
Yeah, a lot going on today. So I think with Powell, the expectations into Jackson Hole were dovish, and he definitely delivered on that. I think in two ways we were surprised. One, he really suggested the Fed was open to a rate cut in September. And rather than just focusing on the unemployment data, he's also focused on payrolls. So all eyes in the credit market, I think, will be to the September 5th payrolls data. Potentially what was even more surprising is his comments on inflation. So, before there was a question of is inflation with tariffs going to become entrenched? And Powell made some comments that, potentially it would just be more transitory. So sort of going back to that 2021 transitory comment. So for us, we were constructive heading into the meeting, and we're gaining some conviction around that view following his comments.
And David, let me ask you about the comments too, and particularly the reaction in the bond market. Were you anticipating such a violent move?
Yeah, I think the market was very excited about getting maybe even a 50 basis point rate cut in September. I think that one of the things coming out of Powell's comments is he's very balanced. There is a dual mandate here, and it seems pretty clear there's a lot more data to assess, and so likely going to take it in a much more measured pace, which seems a lot more prudent.
So the 2-year yield down 10 basis points now. We're at 368, the 10-year at 425. Are we done for the year? Can we go home?
I don't think, the volatility is, I think, going to be, going to continue through this market. I don't think we said definitely can't go home at this point. But I think there's a lot more data to come through. We're going to have to see inflation prints and whether tariffs really are starting to push prices higher for people. We're going to have to look at unemployment data and see where that trends. And so I think there's a lot more to digest before we kind of see where this ends.
Yeah, Meghan, there's a lot to worry about even in what the Fed chair said, right? He said, look, changing labour market dynamics, and they're very obvious. And not just have we got soft numbers on one side, but we also have softer supply. So what will that mean? Is this labour market changing entirely? There are so many questions, tariffs as well, and their impact on inflation. Will it be a one-time shock, or will we genuinely see inflation creeping in week after week to the end of the year, as the CEO of Walmart said earlier this week? What is the base case for you, at least in terms of the labour market and how it's changing?
So our base case is that we see a gradual slowing in GDP growth, but that doesn't mean it's necessarily a negative for credit. So earnings so far has held up really well. So in second quarter earnings, which we just got, we had 5 to 10% EBITDA growth. Margins, which I think is the key question, if we see margin compression, will that feed through to the labor market? So far, margins have held up very well. It's a place we're continuing to look. But I think the key drivers of credit, we still have this secular tailwind of elevated yields. So for us, we think heading into the rest of the year, you have elevated yields that will keep supply relatively lower than it otherwise would have been, and demand from yield buyers will continue to be there. So for us, that will be a key positive driver for credit markets.
David, is there any risk at all that there's some mispricing across credit markets, that we'll look back and be like, oh, of course, it was obvious, after the event, we didn't see it at the time?
Well, look, I think, you can't paint, the market with all one brush. There are going to be certain individual securities that are certainly mispriced today. There is definitely a grab for risk, and that is pushing a lot of prices higher. But I think, to me, to Meghan's point before, I think I go back to the clip you showed from Howard Marks at the beginning, which is when you look at credit versus equities today and think about where the mispricing risk really lies, equities with an S&P with the PE multiple in the mid-20s, you need robust growth just for prices to stay where they are. Whereas in credit, and I agree that you're likely to see the economy start to slow down. We're starting to see weakness in the consumer and the willingness to spend. But if the economy starts to slow down, we still get to grind out a contractual return in the 7 to 8% range, which I find pretty attractive.
Yeah, and David, we've had guest after guest after guest all year come on and say, look, stay, towards the investment grade side of things. Let's not move down the stack too much. But I imagine you're of a different opinion. Where might we see the best sort of value for our dollars right now?
Yeah, to me, it really comes down to, your ability to avoid defaults. Oaktree, we've made a reputation out of going into high yield and other below investment grade asset classes and keeping our default rate low. I like to say Oaktree is a safe place to invest in riskier assets. But if you can keep your default rate low, then I think a yield of 7 to 8% is quite attractive and, frankly, competitive to what a lot of people were hoping to get out of equities going forward.
It's very hard, though, Meghan, to decide I'm going to keep my default rate low, right? How can you be certain that the industries you're looking in, the geographies you're looking in, you're going to see low default rates?
Well, 3 years now after rate hikes, the high yield default rate is still around 3%. So I think there is some resilience that has really shown. And part of that is a lot of issuers have fixed rate and are not really feeling the impact of higher rates. Leveraged loans is a little bit of a different story. We have had defaults around 6%, but that they've come down from the peak, and that includes things like distressed exchanges and restructurings. So I think you do need to look for signs of stress in the private credit markets. We have seen more signs of stress than in the public credit market. So things like a rising share of PIK deals where issuers are selling debt to pay interest is a signpost we should continue to be very vigilant about. But overall, credit metrics to us have shown some stability.
Now, your proprietary positioning indicator shows neutral, right?
Yes.
That would seem to me that it's possible that things could get tighter from here.
Yes, I think exactly right. So positioning that we track for the credit markets suggests that investors are about equal weight or neutral. And so heading into the second half, it's possible that investors still need to add to risk and sort of catch up to the good news that we just got. Good news being a more dovish outcome at Jackson Hole. So there's definitely scope for investors to add to beta.
What, David, does this yield curve say to you right now? If you look across the yield curve, you see the 2-year where it is, the 30-year obviously came down another little bit, but by far maybe less than half the move of the 2-year. What is that saying to you?
I think right now the market is definitely, looking and hoping for rates to successively go down. We'll see. But I think on the long end of the curve, people are being a lot more rational about how much lower can that go. I think people talk about steepening a lot, which is the reality is the Fed can control the short end, the market controls the long end. And when you look at the long end, then you have to start factoring in things like the deficit and other things that we're going to have to fund and, other forces that are likely going to keep rates from aggressively going down.
Well, speaking of other forces, it feels like we have to add, not just the bond vigilantes, but now dollar vigilantes into the mix. Are you looking outside the US and how do dollar dynamics affect your choices?
We are looking. Actually, I find Europe is a very good bargain right now. And it's interesting. A lot of people, talk about the loss of U.S. exceptionalism and they're moving to Europe to kind of hide from a weaker U.S. economy. That's not really the value to me. I don't think you can hide geographically from a recession. If there's a recession in the U.S., the world economy will feel it. But you can hide by credit selection. You can hide by industry. Different credits and industries will do better. But right now, we're finding that Europe is a little bit cheaper than the U.S. And Europe is a smaller, less liquid market, so it should be cheaper, but it's abnormally cheaper, and that creates a pretty good opportunity to buy.
All right, I have to thank you both there for your time today. David Rosenberg of Oaktree, thank you, and Meghan Robson of BNP Paribas as well. And I just want to check the markets. We mentioned the weaker dollar. The Canadian dollar is stronger today. I want to reiterate that Canadian Prime Minister Mark Carney has been speaking and he has confirmed Canada's tariffs on US metals will stay, but there will be USMCA exemptions for counter tariffs taking effect September 1st. That was Bloomberg Real Yield.